Hello, this is Eric Parnell, Chief Market Strategist from Great Valley Advisor Group, and thank you for joining us for this latest market insight. Today I'm joined once again by Evan Coffey, Associate Asset Management at GVA. And what are we going to be talking about today, Evan?
We've got a lot of timely topics to cover. I think that it's a pivotal point for capital markets. But first, I want to thank our Market Insights listeners and audience for tuning in to another monthly edition. They can always find us on YouTube and LinkedIn. Feel free to give us a comment, like, any feedback on the topics that we cover. With that being said, let's jump right in. Our first major theme involves the Fed. It is interest rate decision day, although I don't think it'll be a factor for capital markets, as the CME Fed Watch tool is giving a probability of 99.9% that the Fed will hold rates at where they're at, 4.25% to 4.5%. Moving to July, this number goes down, but not substantially, to 85.5%. And it's not until September that we see the probability of a Fed cut move to 55%. So overall, I think that the CME Fed Watch tool is historically pretty accurate, but I want to do a segment where I give you some points both for a cut and then also for a hold in the next 3 months. And then you can give us your crystal ball, an idea of when you think the Fed might cut and why they might cut moving forward. So with that being said, let's get into the reasons that would favor a cut, starting with their dual mandate of price stability and maximum employment. We got a CPI and PPI reading last week, and it was fairly benign. CPI came in at 0.1% in May, rising 0.1%, and that led to 2.4% year over year. This was under the expected 0.2% month over month and 2.5% year over year. So overall, it seems like the inflation environment right now is rather tepid, especially where investors were expecting inflation to go with tariff implications. Moving to the other side of the Fed's dual mandate, employment, we saw that we got a pretty positive May jobs report a couple of weeks ago. But if you actually unpack that and look under the hood, there was a little bit of softness there. To start, job growth for the prior 2 months before May was revised down by a combined 95,000. And so while this may not feel substantial, this led the overall average monthly job growth for the first 5 months of 2025 to 124,000. Now, this is compared to the 168,000 that we saw in 2024. So definitely some weakness there. And then again, I'm going to get a little bit nitpicky, but the unemployment rate, while it held at 4.2%, if you carry that out to 3 decimals, we actually went from 4.187 to 4.244. So again, some weakness there. And then finally, the elephant in the room, Fed Chair Powell is definitely receiving a little bit of political pressure from the current administration on, the idea of cutting interest rates. So while I don't think he'll be fired before his term is up next May, I do think that he'll feel that heat from President Trump. So those are the reasons for a cut. Now I'll give you the reasons for a hold. The first being this risk asset party that we've embarked on since the middle of April. The S&P is bumping up against 6,000, and the Fed wouldn't want to exacerbate valuations even further. Secondly, if we go back to that dual mandate, the Fed sets long-run goals for both unemployment and overall inflation. This means that they want to target both 4.2% on the unemployment number and 2% on the inflation number. Where are we at now? 2.4 and 4.2. So we're actually further away from inflation, all the more reason for them to hold. So those are the factors both for and against a cut. I'd love to get your insight and opinion on what might be a catalyst for them to cut and when that might happen, whether it's July, whether it's September, or even further out.
Mm-hmm. Well, I'm of the view that the Federal Reserve shouldn't cut interest rates at all. This is a debate that goes all the way back to 2022. We had a big outbreak of inflation in 2022. The Federal Reserve intervened by raising interest rates aggressively, and they got the inflation problem under control. And the concern at the time was that, okay, we have this big raise in interest rates, and it's going to cause an economic recession. That didn't materialize. 2022, we had all the increase in interest rates. The economy did just fine. We got into 2023 and the belief was, the economy's going to slow down. The Fed's going to need to cut interest rates to support the economy. Well, the economy remained stronger than expected and inflation continued to come down. Federal Reserve didn't need to cut interest rates. We get into 2024, the same thing. It says, okay, the Fed's going to cut. They finally did in September of 2024. There was all this anticipation of the Federal Reserve cutting interest rates. And it wasn't until they finally cut interest rates in September of 2024, the market didn't like it.
Yeah.
We saw the 10-year Treasury yield rise, which basically is sell-off in the bond market. We saw the stock market start to top out in terms of the strong rally that we saw going all the way back to 2022. We got 1 percentage point worth of rate cuts over 3 different meetings at the end of 2024. And the economy continued to be strong. Have we seen some weakening so far in 2025? Yes. But that weakening has been on the margins. There's been all this concerns about inflation, particularly in the wake of the tariff announcements that took place earlier this year. But as you said, inflation readings continue to surprise to the weak side. We're not seeing that inflation pressure. There is this instinct that has become embedded with investors going all the way back to the financial crisis to say, hey, if the Fed has the ability to cut, well, they should just go ahead and cut. But why? If the economy is growing, if inflation remains under control, and if the stock market's continuing to rise, supported by corporate earnings, the Federal Reserve is better served to keep that dry powder, to maintain that monetary policy flexibility so that they can cut rates when they need it. But if they cut rates too early, they run the risk of overheating the economy and the markets. That's the last thing that we need right now because we're in a good spot. We have more than double the markets going all the way back to 2022, and the economy continues to surprise to the upside. Inflation continues to surprise to the downside. Let's keep that going.
Now, on the point of political pressure, do you think that that's a factor in July and September?
I think it will continue to be a factor. One of the things that we've seen from the current Federal Reserve is they've shown the determination to hold their ground, to say we're not going to cut interest rates even if we're getting that political pressure. And that's something that we saw during this current administration's first term, where that pressure would be applied to the Fed and they would hold their ground on the most part. And I think that will continue to be true through the remainder of 2025. This is a Federal Reserve that has almost, seemed to be adamant about maintaining their independence despite the political pressure. But that does raise an issue that we need to watch as investors as we go into 2026. The current Fed chair, Jay Powell, his term ends in 2026, and we're likely to see a new Fed chair named. The independence that is maintained by that new Fed chair is going to be something that we're really going to want to watch from a market standpoint, because that independence is critical in terms of maintaining full employment and price stability.
Yeah, well, I think that makes good sense, and it segues us well into our second point and second major theme, which also involves the current administration, and it's what's called Liberation Day 2.0. So we know that this tariff pause is up on July 9th. Markets have rallied significantly, as I said before, since April, and it feels like investors think things are copacetic right now. With that being said, the S&P currently sits at 5982 as of filming, and the risk party is hopping. So as we inch closer to this July 9th date, I'm going to give you a few scenarios once again of what you think July 10th might look like. First, is the day a non-event because we've rectified the current situation or we've pushed out that pause further? Second, is the day a day of jubilation where markets rally because deals continue to materialize, talks continue to finalize on the tariff front? Or third, is the situation one that's more grim because we do get these historically high tariff rates enacted and deals don't come to fruition? So once again, I'm erring on your crystal ball, but I think that it's important for investors in our audience to have an idea of what we think July 10th or leading up to July 10th will look like for investors.
No, it's a good question because we had the market correction on April 2nd. Liberation Day has kind of become notorious for financial markets because of the market reaction. But one of the things that's overlooked with that is that the markets peaked on February 19th, a full month and a half before the Liberation Day tariff announcements on April 2nd. More than half of the correction that we saw in the stock market had already taken place by the time we got to Liberation Day. So if anything, the tariff announcements that came out on April 2nd which were much greater than the market was anticipating. It was a surprise. If anything, it was just throwing gasoline on the fire of the correction that was already underway. And the market bottomed 5 calendar days later on April 7th. And we saw a lot of volatility through the middle of April. But if anything, it kind of pushed the final washout of the markets. It's my view that this second Liberation Day that's coming in July 9th is likely to be a non-event.
Okay.
We think about the current executive and the book that he wrote. It wasn't the art of the decision, it was the art of the deal. And what does the second Liberation Day coming up on July 9th basically provide? It provides a new inflection point for, hey, we're open for deals as the United States in terms of how we're going to negotiate trade going forward. I don't think any type of announcement, I think the current administration learned from the announcement on April 2nd to say, we got to make sure that we don't shock the markets. So I imagine that they will try to tee this up as much as possible to say, hey, we're open for negotiation as the United States, but we're not going to shock the markets in terms of what we put out there come July 9th.
Yeah. So you heard it here first. Hopefully July 10th is a non-event day. This brings us to our final major theme of this Market Insights video, which is what's on everyone's mind right now, the tension in the Middle East. You recently wrote about it in your economics and market report. We saw Israel launch an attack on Iran last Friday. Markets had a pretty visceral reaction to this. And I know that we were quoted on the last Market Insights saying that the market tends to buzz right over geopolitical tension. Why did we see such a fierce reaction on Friday? All major indices down over 1%. And what can we expect to see going forward with this? Why are investors worried about it? I mean, I know that we had a bounce back this past Monday, but we've really had some pretty significant volatility since then. So what is your outlook on this situation? What is the effect on financial markets, corporate earnings, inflation? Give our listeners an idea of what we need to expect going forward.
Yeah, no. So a couple key points to unwrap with that. And the first, markets hate uncertainty. And when you have a geopolitical event, it injects uncertainty. You have things that are playing out in the world that affects markets that causes investors to pull back. But if you take a look at market history, and we have, over 150 years worth of market history to look at, is to say there is an immediate market reaction to that uncertainty. But once investors have a few moments, that could be a couple hours, that could be a couple trading days, to stand back and evaluate the situation, more often than not, we see the market respond favorably. And there's several reasons for that. And we take a look at the current situation in the Middle East as an example of this. It's not likely to affect expected economic growth in the United States. Inflation, we'll get back to that point in a second, not likely to have a material impact on corporate earnings. I mean, less than 1% of our exports out of the United States go to the Middle East. We don't actively trade in terms of goods with the Middle East. So it's really a question around, what's the policy reaction? And there is that inflation notion that's out there in a minute, that we'll talk about in a minute. But the market isn't likely to react very much to this. If anything, it could be something that pushes the markets to the upside on net before it's all said and done. Inflation pressures are under control. And the more uncertainty that's injected by a geopolitical event, the more central bankers from around the world, including the US Federal Reserve, are likely to come together and say, hey, you know what? Let's inject some liquidity into the system to help support financial markets and ease that uncertainty. If anything, a geopolitical situation or a geopolitical event could be a net positive. We have seen that in the past. A classic recent example, the events of 9/11 back in September 11th, 2001. I mean, here's a situation that wasn't taking place in the Middle East. It was taking place in New York City, in the heart of the global financial system at the World Trade Center. The markets were closed for 4 days. When they reopened, they traded lower for 4 trading days, but they bottomed. And by the middle of October, roughly a month after 9/11, they were trading higher than where they were before 9/11. And this was in the midst of the bursting of the tech bubble, an attack on the United States. And it was trading higher than it was prior to the event in the midst of a major market correction that was playing out over 2 years. Why did that take place? Because policymakers intervened with a massive amount of liquidity in order to support the financial system. Let's go back even further. World War II, the attack on Pearl Harbor, December 7th, 1941. The markets traded lower for the first few months after Pearl Harbor, but that was because we were basically going to war. And we were shifting from a peacetime economy to a wartime economy. And that had an effect on corporate earnings. So it's something that would affect stock prices. The stock market bottomed, and this is in the aftermath of the Great Depression. The stock market bottomed in April of 1942 at a time when we still didn't know how things were going to play out. We were only entering into a world war. And for the next 3 years through 1945, the stock market consistently rallied and moved to the upside. If the stock market can shake off, and not only the stock market, but if capital markets can shake off those two events and rally to the upside, it can certainly shake off any type of turbulence we see in the Middle East. Now, one last point to mention, what about the risk of inflation? We saw oil prices spike. Well, yes, we saw oil prices rise, but it's important to note that oil prices were down double digits year to date before the Israeli attack on Iran and the Iranian counterattack on Israel. They have spiked, but they've spiked to basically flat year to date. And if we go to the gas pump, we see that we're basically paying half for a gallon of gas today than we were paying in 2008, 18 years ago. So on an inflation adjusted basis, we might see some higher prices in the short term, but not enough, at least to this point, that would cause any kind of material impact on the markets.
So to investors, clients that come to their advisors or their financial professionals and say, hey, I've seen oil go from mid-50s a barrel to over $76. We've seen 20+% gains. You just don't think that they'll see this at the pump?
I don't know that they'll see it at the pump, and I don't know that they'll see it materially in their investment portfolios over any period of time. And for me, it really highlights that key point. We have economic events that take place over time. We have geopolitical events that take place over time. And the impulse for investors is to want to do something. They turn on the televisions, they see the news flow, they see the market reacting, they feel like they want to do something. But the last point that you want to go and try to make a change in your investment portfolio is when turmoil and turbulence is happening in the market. Allow those events to play out. Stick to your long-term investment plan. If you have put an investment program in place, it is designed to be prepared and withstand these types of events. And we have seen time and time again, the economy and the market's ability to shake off these events and move higher over long-term periods of time. And that's really, highlights once again the importance of sticking to that long-term discipline.
Well, Eric, I think we covered a lot of good ground today. It was great to talk to you about these topics, and I look forward to our next Market Insights video.
No, thank you, Evan. Great topics to discuss today. And thank you for joining us for this latest Market Insight. And I look forward to seeing you again soon.